Now, ICICI Lombard is losing on the back of what is being seen by analysts as a weak fourth quarter performance. The company saw growth in net earned premium, but still was below expectations. Their fourth quarter loss ratio is also expanded, although their profitability is above what was being expected by the street. Gopal Balachandran is Chief Financial Officer and Chief Risk Officer at ICICI Lombard General Insurance. He's joining us right now to take some questions. Gopal, good to have you with us here. Good morning. Thanks for your time. Some specifics straight off the bat, Gopal. What kind of trends did you see in the motor third-party book? If you can start there, and why is the loss ratio there gone up?
So good morning, Prashant, and good morning, everyone. So on motor third-party, I think specifically, as we keep saying, you have to always look at the portfolio loss experience over longer horizons, because this particular segment exhibits very long tail of claims development running into several years. So hence, in a particular quarter, you will always find aberrations in terms of the loss experience. A better outcome is to kind of look at the loss ratio numbers more on a year-on-year basis, which if you would have seen, let's say for the year gone by, for motor third party, the loss ratio was at about 72%. In fact, this number is slightly lower than what we had seen for the last year, which was about 74. Quarter, as I said, obviously there are multiple factors that goes into it, and hence to that extent, one should look at more on a year-on-year comparison.
All right. Hi, good morning, Gopal. Thanks so much for joining in. Well, I'm looking at your numbers in ICICI Lombard. You all sold a large motor pool of close to around 280 crores or to a peer in February 2023, right? Now, what would have been the combined ratio if you didn't sell this?
So again, good morning, Nigel. So to my mind, as we had kind of put out, it's more a one-off transaction that we have done, and what we were explaining also in the analyst call yesterday, it does not have any kind of a material impact insofar as the combined ratio is concerned. Having said that, the transaction is definitely a commercially viable one, but in terms of the impact on the combined ratio, it does not have a material impact, even if you would not have done that particular deal. Okay, all right. But you have been guiding that the combined ratio will come in lower. I think you were guiding for around 102% odd. How do you achieve this? Going ahead, what kind of rationalization steps will you be looking at? Yeah, so absolutely. So again, when you look at maybe if I were to step back, maybe a year and a half back, at which point of time maybe the combined ratios, when we kind of did the integration with Bharatiya AXA, stood elevated at 105 on a blended basis. Even at that point of time, we had said possibly for FY23, we will look at getting to a combined which is around 104, which is what we have been able to achieve. And even at 1 year back, we had kind of spoken about by FY25, possibly to get the combined ratios down to 102%. So there are multiple levels that we kind of work with. Clearly, in terms of increase in pricing is one of the levers that we kind of largely look at. For example, on the retail health, this February, we have kind of effected a price increase of about 19% on the renewal part of the health segment. So therefore, pricing is definitely one of the levers that we have. We equally look at actively focusing a lot on claim service efficiency, because that typically forms the bulk of the combined ratio breakdown if you were to look at. And third, and more importantly, we will continue to make our investments in various areas of expanded distribution, but early signs of success of those investments translating into incremental revenues is already something that we are seeing. So hence, efficiency and operations will also be the third lever that one will look at.
Okay, so you're saying a combined ratio of 102% is what you hold on to by FY25. Got that. Can you tell us for FY24 particularly, what are you looking at in terms of a premium growth as well as on profitability? What are the numbers that you're targeting?
So again, that's a great question, Sonia, because so again, let me kind of step back. If we were to kind of look at this market, not just for the year gone by, even for the year gone by, the industry clocked about 16.4%. And for ICICI Lombard, we had a share above the market at about 17%. But even if you look at longer horizons over the last 15 years, the market has compounded at 15%. And given the opportunity that one is seeing, even in terms of the road forward, particularly when you look at, let's say, FY24 or beyond, we believe the market should continue to grow in the range of 15 to 20%. And from an ICICI Lombard standpoint, we would obviously want to see a similar kind of maybe beating the market by maybe 1 or 2 basis points over the market growth rates from a revenue perspective. On the combined ratio, as we have kind of spoken about, I think the current combined exit was closer to about 104. Directionally, we would obviously want to see a declining trend in combined even for FY24. And as we head into FY25, get to that number of 102%.
I got that. Gopal, could you confirm if so there has been this ongoing GST investigation with regards to general insurers. Could you confirm if ICICI Lombard has also received a notice?
So I think insofar as the tax matter is concerned, I think as you rightly said, across the industry, multiple players in the markets obviously has been kind of called for informations and documentation. And even from an ICICI Lombard standpoint, we have been submitting and extending the necessary cooperation that is required insofar as the tax authorities are concerned. And hence, we will obviously wait and see how things kind of further shape up on that.
It's a tax demand, Gopal?
At this point of time, we have not necessarily received any particular demand notice. As I said, this is more currently at the stage of seeking information and documentation. And in line with what, let's say, other players in the market are also kind of exhibiting, we are also extending necessary cooperation in terms of making those information available to the tax authorities.
All right, Gopal, what's the outlook for crop insurance for FY24? That's post the acquisition of Bharatiya AXA. Will it be around 4 to 5% of your total business? Just give us some outlook on that vertical.
Yeah, I think, so again, Nigel, what we have been kind of talking to the market on the crop side is obviously we would want to continue to stay invested in that segment. But having said that, you're right. If you look at the overall mix of crop to our aggregate revenues has been at a single digit number. And even as we kind of head into FY24, the process is obviously to kind of see that number staying around that levels of between 4 to 5% of the overall revenues. That's the thought that we have on the side.
Okay. I also wanted to know what is the progress as far as the banca channel partners are concerned, Axis Bank, HDFC Bank, what kind of market share have you gained and what does the way forward look like?
So that's a great question, Sonia, because at the time when we kind of announced the Bharatiya AXA transaction, obviously one of the things that we, amongst other things that we were able to get as a part of the deal was access to a couple of large private banks, as you rightly mentioned, both Axis as well as HDFC Bank. And clearly at that point of time when we announced the deal, the market possibly had an apprehension as to these distributions will subsist with us in terms of the long-term prospect. We are extremely happy to note that we have been able to kind of subsist that even as we speak. And clearly what we have been also able to do is to increase the wallet share, which in the past used to be a single digit number in terms of contribution because Bharatiya AXA had got access to both Axis and HDFC very recently. And therefore, they are a single-digit wallet share in terms of both those distribution partners. Today, over a 2-year cycle, we have actually been able to get into a double-digit market share in both of those distribution partners. So very, very excited with the way how things is playing out, particularly with respect to those bank partners that we were able to get an access to.
Gopal, now this is something we've discussed earlier as well, but now with the new expenses of management guidelines, could you tell us what is the, what's the thinking? How much can you get the EOM number down by each year? I think you were at 29.6% in FY23.
Yeah, so Prashant, so one, if you ask me directionally, again, this change in the expense of management guideline is an extremely positive development because as you rightly mentioned, this particular regulation kind of looks at the transaction more at a company level, and the regulator has put out a threshold at 30% in terms of what you can have as expense of management. From an ICICI Lombard standpoint, consistently, not just the year gone by, but even otherwise, we have always operated within that threshold of 30%, and hence to that extent, we are kind of quite comfortably placed. When you look at the market participants, which is public information, many players in the market are actually operating at a threshold which is more than 30. And there, in fact, the regulator has given a glide path to bring down their expense of management to less than 30%, which we believe from an ICICI Lombard standpoint, actually an opportunity for us to possibly look at maybe increasing market presence.
Gopal, this won't affect business development in individual segments as, to kind of operate the way you want to?
So in fact, the change in the regulation is exactly that, because earlier we were actually having further sublimits in terms of individual lines of businesses, in terms of what you could expend as expense of management. But the change in the regulation exactly is done away with sublines or sublimits in terms of individual lines of businesses and give the desired flexibility which the industry has been seeking. And the regulator has rightfully responded to make sure that they will monitor the overall expense of management at a company level. Now it's for the individual companies to decide how do they want to kind of use that expense of management threshold in terms of the various segments of businesses that they want to kind of underwrite or source.
Okay. Another question that I'm sure a lot of investors have is whether you would want to at some point enter the life insurance segment as well, which would complement your current health portfolio. Any plans of doing that?
So at this point of time, we have not thought about that, Sonia. I know that there has been a lot of conversations that has been happening in the context of a composite license. But to answer your point, at this point of time, we have not thought about that. But honestly, I think we will wait for some of these developments to happen and maybe take a call at an appropriate time.
Gopal, we have sort of large conglomerates thinking and talking about entering the space. Geo is one, right? And the number of players generally also is set to go up over the next couple of years. I mean, we have the data from applications to IRDA to start a insurance business, not just general, but life as well. So competitive intensity will go up. So when earlier you said, I mean, you've got three levers. One is pricing. The first one we mentioned was pricing. How much of that is that going to be a lever going forward in what is going to be a highly competitive scenario, according to you, briefly?
I think that's a great question. So if you look at, when you look at our combined ratios, Prashant, we are, as I said, operating at a combined of 104. But if you look at the market is operating at a combined of 116 to 118%. So clearly, I think insofar as the stress that is getting exhibited on players in the market and their ability to continue to remain competitive, obviously will be put to question as we kind of look forward. Plus the fact that I mentioned that many players in the market are already operating at an expense of management greater than 30%. And there again, they will have to obviously look at bringing down their thresholds to less than 30. That again by itself presents an opportunity. To your point on competition, this market has always seen a lot of entrants kind of playing out. And the current regulatory theme being to significantly drive penetration is where maybe there is a significant interest on competition as well. Over the last several years, we have seen many players entering, and therefore that is definitely a welcome step. The question is, we will have to see which product line, which geography does each of these new entrants are kind of actively looking at. If it is with respect to a particular geography or a particular product line, then therefore to that extent at a company level or maybe at an industry level across lines, we may not see so much of competition. But if it's an entrant who wants to look at multi-line, multi-presence, then we will have to wait and see how this space plays out.
Gopal, you've given us the guideline in terms of combined ratio coming down to around 102%. And as you said, it's much lower than what, currently as well, much lower than what the industry average is. What about loss ratio? Can you give us an outlook for FY24?
So, Nigel, it's a combined ratio because there are various moving parts in terms of the loss experience as well as the expense ratios, which are typically the components of the combined. And there could be different segments that will exhibit maybe higher loss ratios and lower expenses. Equally, there are segments which operate with maybe lower loss ratio and higher cost of distribution. So the way we would obviously want to transition is a mix of both. So hence, to that extent, we would not be able to specifically put out a number on the loss ratio. Having said that, historically, if you were to see, our loss ratios have kind of tended towards a band between 70 to 75%.
Okay, all right. That was a very extensive discussion. Thanks a lot, Gopal, for joining in. That's ICICI Lombard with the business and the way forward. Let's slip into a quick break. On the other side of the break, very quiet market, not too much happening, but Mitesh Thakkar will be joining in to give us some technical trades, so don't go anywhere. Stay tuned for that.